Okay, next up, the balance sheet. So the first thing that you want to look at on your balance sheet, I know a lot of people ignore this, but it's actually a very important financial statement, is your cash on hand. This is extremely important. Most businesses go out of business because of cash. So you want to start making it a goal to have at least 3 months of fixed expenses in your bank account. And then after that, a 6-month goal. If you want to start with 1 month, that's fine. So let's say on your profit and loss, your fixed expenses, not your cost of goods sold, but your fixed expenses are $10,000 per month. So your first goal would be to have and maintain $10,000 month over month. Then your next goal would be $30,000, 3 months, and then your final goal would be $60,000. So that means when you look at the bank account and it says you have $10,000, that doesn't mean that you have $10,000 to spend. That means you have $10,000 to cover your expenses for the next month. So the next thing you want to look at is accounts receivable. Is this number too high? Are we collecting on those? There's other reports that can help you with that. You can also look at this month over month as we did previously by clicking display columns by month and see if your cash is going up or down. If it's going down, that's a bad sign. If it's going up, that's a good sign. Same with accounts receivable. If it's going up and that's because sales are going up, that's good. But if your sales are consistent and your accounts receivable is going up month over month, that could indicate a problem. Someone's not paying, and you may want to revisit your accounts receivable. The next thing you want to look at is this equity down here. This should be positive. If it's negative, like in this example, that means you are overextended. That means that the company's the operations are basically being funded by debt instead of actual profit. So that indicates there's a problem with the company. And then a couple things that you can look at to see if your financials are accurate. Opening balance equity should always be 0. If that's not 0, there's an issue. You shouldn't have negative accounts except for depreciation and distributions generally. Those are okay. And then you also want to make sure your bank and credit card balances match the actual amounts on your statements, or at least are fairly close. If you go in here and you have a bank balance of negative $72,000, which I've seen before, but your bank balance is actually $1,000, and that's clearly something is wrong in your financials in QuickBooks. This is not accurate. So this can tell you 2 things. Your balance sheet should help you answer what is the overall health of your company, and are my financials accurate? If your balance sheet is wrong, your profit and loss is almost always also wrong and needs to be fixed.